Hi, welcome to this video today, which is all about Forex fundamental analysis and technical analysis, which is the best way to trade the Forex markets. It's a commonly searched question online. Most retail traders, beginners, are going to go for a purely technical approach following price action. They're going to end up losing. Forex technical analysis, yes, it has its place in Forex trading, but if you just want to be a price action trader, your chances of making money are very low, and I'll explain exactly why in a moment. Now, is Forex fundamental analysis the best way to trade the markets? My own view again is no, because yeah, sure, economic facts are important, but only in terms of how investors see those facts, i.e. the sentiment of all traders towards the economic data. Best way to trade the Forex markets is to do simple sentiment analysis to the fundamentals, because that is going to be reflected in the chart. The chart doesn't come out of nowhere. It's not a scientific formula or the past is going to repeat into the future like many traders believe. So you can use sentiment and fundamental to generate the trade idea. Just use very simple analysis. I'll go through how to do it in a moment. Then use your technicals to manage your trade idea. Then technical analysis becomes very effective and you can keep it very simple as well. Right, what we're going to do is we're going to go to a storyboard and discuss all these points in more detail. Right, let's have a look at using fundamentals, sentiment towards them with your technicals to give you a robust trading strategy with an edge that will make you money longer term. Now, I've repeated the point above, which I just said in the intro. Price action is a direct reflection of trader sentiment towards the fundamentals. Does not form on its own. It does not repeat in the way that technical traders think, that the past should basically repeat into the future with patterns. It just doesn't work that way, okay? There's no edge following pure price action, because what you have is what's called a clustering illusion of order. What that means is the price patterns look orderly, but only in hindsight. They might have formed randomly, okay? They're only obvious in hindsight. Done a full video on this, going through the clustering illusion, what's also called the Texas sharpshooter fallacy. If you haven't seen it, go and look it up, because it's why technical analysis is so appealing, okay? But actually doesn't work in the real world. If you were to do, and many people have, tests on price patterns, any price pattern you wish, head and shoulders, tops, bottoms, Gartley patterns, wedges, whatever, they're tested in the real world, going backwards for a long enough period of time, you'll find that those chart patterns, all of them, are no better than random. So you may as well just toss a coin, okay? You've got no directional bias. If you haven't got directional bias of where a currency pair might go, and that can only come from the sentiment towards the fundamentals. You don't know if a trend change is near, a big trend in motion is going to continue, or maybe a Forex pair is going to do nothing and just chop sideways. Hard to catch trend reversals and follow big trends. After the event, they're obvious. Of course they are. But the warning is going to come from the sentiment towards the fundamentals in terms of a trend change. And in terms of following big trends, price action traders simply can't do it. They've got no directional bias. They do not know the weight of money or the sentiment behind the charts. They can't actually postulate how far it might run. So all that means is as soon as they've got some profit, they're either going to snatch it early on the first retracement because they're frightened the profit's going to get away, or push their stop up too close to protect the profit and get caught in the noise. And noise levels, i.e. random price movement on Forex charts day, is extremely high. Now, in recent years, there's been a change in market structure. And what I mean by this is that when I started trading back in the late 80s, pure price action technical traders could make money. Why? Because you had such high volatility and you didn't have the internet, which meant you had very smooth trends with very little in the way of pullbacks. Okay. Now, in terms of the internet, it changed Forex trading forever and killed technical trading. There are no big top traders today that use a purely technical approach. The reason why the internet changed trading was because everyone had the price action at the same time. That means trends are not going to be smooth. to give you a simple illustration, you have got the same information as the big boys at the click of a mouse because of the internet. In the old days, that wasn't true. News releases would first go to the floor traders. They could be the first to act, start the trend. Then it go to banks and big brokers. They'd be the next in. They would come in and continue the trend. Then the retail traders would come in last and continue the trend. It'd be much smoother. They're not all coming in together. Now, in terms of trading, price action, there is a view that all fundamentals are instantly discounted in price action. Well, they're not. In terms of price action traders, so no point following fundamentals. It's all in the price straight away. But is it? No. George Soros has famously proved this with his theory of reflexivity. And to give you a simple example, bullish news event comes out for a currency. It goes up as traders buy. Now is it discounted in the price action? No, because traders who have bought might decide to add to their positions after the event. Other traders seeing the price go up might fear missing out, so they'll jump in on the trend as well. So it's not instantly discounted in price action. Now you have a huge army of educators who say pure price action trading works. Well, if it does, why don't they show their trades in advance? I've made this point on numerous occasions. They don't. They can only make it work in hindsight or giving vague advice, like if it goes up, buy the currency. If it goes down, sell it. Then they're right after the event. Now, we do give our trades, and we have done for 20 years. And we know we can do that with confidence and win over the longer term because we're not just using price action. Sure, we're using technicals, but the fundamentals and sentiment are helping us get an edge. So that price action trading on its own, it's very alluring, let's say, to believe you can just look at a price chart, make money from it. It's not the real world, okay? Fundamental analysis. Now, in terms of, I said in the intro, the actual sentiment towards the big fundamentals is just so important. Over the longer term, the big fundamentals will rule. Okay, let's say you've got really bullish economic data that just keeps coming out bullish. Yeah, that will generate a big price trend. But very hard for most traders to judge the fundamentals and deal with the sentiment spikes in the short term, because obviously traders are basically pushing prices too far to the upside or downside. When greed and fear come into play, then you get the recoils, okay? Very difficult for most traders to trade off the big fundamentals. Drawdown's too big. So you need to know the sentiment. What you're out to do is work out how bullish or bearish the sentiment is and watching for extremes. Extremes are where you need to be very wary of a trend change. The market, if it's not overbought or oversold and sentiment, okay, it can be bullish or bearish. The economic data is coming out, in favour of one currency over another. You could go with that trend, but you've got to be very wary of the extremes. In terms of our way of trading, we will use the big fundamentals for the big trends, okay, but very keen to watch sentiment to know when it's run on too far to the upside or too far to the downside in the short term. And also very, very alert for those extremes. When you've got traders universally bullish or bearish, then we can come in and hopefully get a trend reversal. When you use sentiment towards the fundamentals to generate the trade idea, you've then got the directional bias. Then your technicals can help you manage the trade. You can be very sort of alert, for example, if there is a big trend, to use maybe a small position size and keep your stop back, okay? Give it a little bit of room. In a big move, let's say we price a push to overbought or oversold, high volatility, get universally bullish or bearish consensus, you can then come in against that consensus with a closer stop, for example. Done plenty of videos on sentiment analysis towards the fundamentals and then using technicals to basically manage the trade. And well, we've got numerous videos online of actual examples, and those actual examples include the entry, stop, and target. You don't see price action traders do it because they can't. One of the real difficulties, said this frequently in videos, is getting in on a trade is very often very easy. Your entry strategy can be very, very simple. Managing the stop is the harder part for us, and managing the stop, how far it should be away, what your position size is, and so forth. You get real help from that by studying the sentiment towards the fundamentals. So, no, in my view, do not be a pure price action trader. It is, a kind of alluring story, but in the real world, it isn't going to work. There's nothing intimidating about studying sentiment towards fundamentals. Anyone can do it. Okay, just takes a little bit of practice. Everything in life you want to become good at is going to take a little bit of practice. Use simple sentiment fundamental analysis, then just manage your trade with your technicals, and you'll have a simple, robust strategy that can give you an edge. Longer term, you can make profits from the Forex markets. Right, that is the video for today. Thank you very much for watching me as usual. Take care. Have a good day.